From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, still sticky inflation has Fed officials sounding hawkish, fueling a continued climb in Treasury yields with signs of weakening demand at Thursday's 30-year sale. We begin with the big issue. Maybe the Fed's job isn't finished yet.
We have a lot of pricing pressure from services.
Fear of a reacceleration.
Reacceleration.
Where is that reacceleration going to come from?
The economy is losing momentum here.
In some ways, exactly what the Fed wants.
Potentially at the end of rate hikes.
I think they're done on rate hikes.
I don't think the Fed has done enough.
Wage growth running around 5%, that's not an economy that's going to bring inflation back down to 2%.
The door's open for a hike in November.
It could be that the Fed skip the next meeting and then hike again, 25 basis points.
Raise rates a little further from here.
We also don't see rate cuts in 2024.
Might even see more rate hikes.
We have a lot of cross currents, as I said, in the data.
The Fed sees combating inflation as a marathon, not a sprint. It's become a relay race.
Joining us now, I'm thrilled to say we have Wells Fargo's Erik Nelson and Matt Diczok of Bank of America. And Erik, it's late in London, so we'll start with you. When you put together everything we learned on the economic front this week, from PPI to CPI just in the past 24 hours or so, what does that mean for the Fed's path forward from here?
Well, Katie, I think the balance of data this week on the growth of the labor market side was pretty good. Claims are trending back lower again, both on initial and continuing, so that's good news. The CPI print was obviously soft, but it was largely expected. And I think there's a lot of people focusing on some of the forward expectations for inflation, not just oil prices, but still a little bit of wage growth and nominal income growth left in the pipeline here. So it seems like it's going to be tough for the Fed to see sustained return to 2% inflation anytime soon. That to us makes it look like the balance of risks is for more hikes as opposed to the cuts being realized that are currently being priced into markets. So from that perspective, I think rates are, probably still going to hang around these levels, if not drift a little bit higher over the next few months.
Well, we had plenty of Fed speak to chew on this week. San Francisco Fed President Merill saying this week, quote, "It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing down inflation back down to its 2% target." Of course, speaking about that inflation print. Matt, what does more work from here mean, though? Does that necessarily just speak to rate hikes or the idea that they're going to stay on hold here for longer?
So good question. And from our perspective, we are at a restrictive level of monetary policy right now, with quantitative tightening kicking in again as reverse repo program stays relatively more constant here, with real rates quite high. We think what doing more means is just staying where they are for longer. So obviously, Bank of America Global Research has the forecast that we don't start to see Fed hikes till the back end of next year at this point, but just staying in this restrictive territory for close to another year, that should be enough. And to be fair, the market has been signaling this for over a year now. Break-evens across the curve, 5, 10s, 30s, has been telling you inflation is not a long-term problem. It's going to get behind us with the Fed continuing to stay restrictive.
Yeah, the bond market definitely putting its faith in the Fed's inflation fighting prowess. But Erik, what does a policy mistake look like at this point? Is that the Fed doing too much, being too aggressive, or doing too little now?
I think the tough thing, Katie, to be honest with you, is that they're kind of worried about both because you have to balance two things that they've never really had to balance before as an institution. One being, you have an obvious inflation problem, right? That's not going away anytime soon. Whether it's core headline inflation, there's still risks here to the upside, and markets are increasingly focusing on those. And at the same time, you have a much more financialized and also debt-laden economy that you really didn't have back in the 70s and 80s, the last time you had a real inflation problem. So they are worried about over-tightening and under-tightening, given the sort of those competing risks. And that's what makes both the Fed's job hard and also the job of those of us trying to gauge what the Fed will do and what the market will do. And so you see that reflected in rising rate vol. I think that probably continues to stay pretty well bid. And I think it also makes me sort of more worried about this sort of narrative that the risk reward is very good for buying duration right now. I think there's not enough people focusing on what if there's risks on both sides. I think that needs to be more part of the conversation right now in the market.
This is exactly where I wanted to go because, Matt, I'm looking over your notes. You sent them at 12:32, so I had to read them quickly. But you write, get long duration, sort of taking the other side of that trade. Tell me about why getting long duration now makes sense.
Yeah, just in time delivery on those notes. Little supply chain logjam this morning on a summer Friday. Sorry about that, Katie.
No, this is enough time.
So the way we think about it, we like to move, incrementally. And so when the 10-year was at 50 basis points, Fed wasn't going to go below zero. Great time to be extremely short duration. We took portfolios as short as we could. Now we're at essentially roughly 2% real yields on 5-year tips. We are at the end of the rate hike cycle or very close to the end of the rate hike cycle. We have either a recession or a soft landing coming. All this is lining up in our perspective as a great time to be at least slightly long duration. Now, to Erik's very good point, there could be upside to rates. One of the things we highlighted in a report about a month ago, which, again, timing was just lucky on this, was that one of the things that could force U.S. rates higher is what happens in Tokyo, right? Fed has moved from 0% rates to 5% plus. European Central Bank has moved from 0% rates to 4% plus. Bank of England has moved from 0 rates to 5% plus. Bank of Japan still has negative short-term rates, right? So as they if they let their 10-year increase, it's certainly possible you see a move to higher levels in the 10-year. But if that happened, we would get even longer duration at that point. So right now, we're absolutely in the slightly long duration position. We think the Fed's restrictive enough. If you look at lending standards in the banking sector, those are quite tight at the moment. The Fed's going to get what it's asking for with higher unemployment, with slower inflation. But even without that, right, 2% real yields on the 5-year tips. Again, you have to go back 15 years to the 06-07 time period where you saw 5-year real yields at that high level. And it didn't even stay there for more than a year and a half. That, from our perspective, is a wonderful opportunity for savers after years of financial repression. We want them to extend out and take advantage of those longer-term yields.
Let's talk a little bit about entry points and the point you make on the Bank of Japan. It feels like the ultimate wild card. But I look at 30-year yields, 10-year yields too, but 30-year yields, they're up about 30 basis points in the past month or so. So when you're thinking about entry points for long duration, you say you're already slightly there. For people coming in and looking to extend duration, is now the time or would you wait a little bit, Matt?
No, in our position, in our preference, now is the time. Again, because risk is always two-sided. So certainly there are risks to higher rates, but there are also risks to lower rates, right? China seems to be seeing softening data, both at exports and imports and inflation data. There are always wild cards out there. So from our perspective, at the beginning of the rate hike cycle, you're concerned more about rate risk. You're concerned more about long-term rates moving up. Now the balance of risks suggests that long rates are high enough and short rates are going to have to come down, not immediately, but you don't know exactly. But towards the end of next year is our base case. But again, any wild card risks could accelerate that move short-term rates lower sooner. The important thing to think about here is we want to move in incremental ways. And the balance of risks, again, suggests that reinvestment risk is more of a concern than rate risk at this point. Think of like what's been thrown at the Treasury market. We had deficits at 8.5% now. Global financial crisis, we got to about 10% deficits. Deficits are super high for peacetime right now. Fitch downgrades U.S. Treasury. Higher deficits mean we're seeing a lot more coupon issuance. Bank of Japan releasing their 10-year. Everything's been thrown at the Treasury market that could have been. Where's the 10-year? It's still below the highs of October, November last year. It got above 420. We're still at the 415 level. With everything thrown at the Treasury market, we're still at those levels. Again, does that mean get uber long duration? No. Does that mean get slightly long? From our perspective, at 2% real yields? Absolutely.
Erik, give me the other side of that. When you think about specifically the long end of the curve, in your view, is there more of a sell-off to come?
I think the tough thing here, Katie, for some investors is the carry. If you look at just how inverted the curve is, right? It's tough to sit in a long duration position, especially that far out the curve at 30 years, given how inverted the curve is. And so I sort of maybe offer a counterpoint in terms of where we are in yields. Look at the price action yesterday. You had a on consensus soft CPI print. You've had pretty, generally dovish to maybe balanced Fed speak over the course of this week. Jobless claims came in a little higher than expected. Maybe there's some quirks there. But the overall data, were such that you wouldn't expect to see a 10 or 15 basis point sell-off in the 10-year yield, and that's exactly what you got. Now you can of course pin this on the auction, but I think the overall it was a pretty fragile market. You can sort of sense it in the aftermath of the CPI print. So I'm probably still more worried about us retesting those highs from last fall than I am about the downside risks here for yields. Even if I don't think I'm not necessarily expecting 50 basis points of upside here, but I think the carry and the upside risks here make it such that it's not too enticing in our view to get long right now.
And Erik, we only have about 30 seconds left, so I want to end with you on a wild card. I've been a little bit obsessed with 20-year treasuries this week because you look at the yield, it's 18 basis points above the 30-year treasury. What's that about? How are you thinking about the 20-year sector, which we never talk about?
Well, Katie, you never talk about it, and a lot of clients don't either. A lot of, especially the old school guys who'd rather just literally buy anything else. I think you got to be careful here because people are have pretty ingrained views in terms of whether they want to buy this thing or not, no matter how cheap it is. And usually, if it gets to a certain extremes, especially some of the hedge fund clients will want to get. Sort of correct some of those mispricings, but learn that mispricing can get pretty significant before it finally goes the other way.
All right, good note to end it on. Really appreciate this. Erik Nelson and Matt Diczok, have a great weekend. Up next, it's the auction block. McDonald's looks to get ahead of the maturity wall with a $2 billion sale. Details next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where today saw the 25th zero sales day of the year in Europe. It wasn't totally quiet, though, with more than 4 billion euros of weekly issuance, featuring Mercedes-Benz with its first sterling deal in 4 years. Meanwhile, in the U.S., some well-known names with sales, including the likes of Goldman Sachs and McDonald's. The bank sold nearly $2.8 billion, while the restaurant chain sold $2 billion. And in high yield, you had real estate firm Cushman & Wakefield with its first sale in 3 years, selling $400 million. Meanwhile, calls for a soft landing piled up after the U.S. CPI print on Thursday, but Guggenheim's Ann Walsh staying defensive.
I don't think the market is really pricing in sort of the next shoe to drop, and that's credit. There's so many cross currents of information that are happening right now that really investors are trying to fight the Fed. And the Fed is very much focused on continuing to fight inflation. They're going to keep rates higher for longer, which was actually what we anticipated. And they're going to continue to work to slow down the economy. And frankly, I know recession seems to be off everybody's mind, but I think that that's probably a mistake at this point in time.
Joining us now, Invesco's Matt Brill and Barclays' Meghan Graper. And Meghan, I want to start with you where Ann left off. Is there a shoe to drop in this market, and is it credit?
Yeah, I mean, great question, Katie. I think spreads have taken a breather for sure, but I think it's fair to say yields continue to be the driving force in investment grade credit. So, irrespective of where investors sit on the globe, most of the accounts we're talking to are continuing to look for attractive carry opportunities to ride out the summer. And with that demand consistently outstripping supply, I think it's creating a real insulatory effect and a willingness to throw out historic August playbooks to source actionable new issue windows. So, we saw that yesterday where despite rate volatility, we delivered the largest CPI day for the dollar primary markets since the first quarter of last year. That was really spearheaded by ONEOK's $5.25 billion offering, where Barclays helped the company garner, upwards of $35 billion in demand in a matter of 3 hours. So there's ample liquidity flooding into the system, and that's playing out in Europe as well. It was mentioned in the intro, but a market that is normally shuttered by early August is continuing to remain open and actionable. Our team executed a $500 million sterling transaction for Caterpillar midweek, and we did a subordinated deal, so down the capital stack for SEB, the Nordic bank, just yesterday. So risk appetites are intact, and from where I sit, technicals are unquestionably winning out.
Let's just meditate on that for a little bit longer, Meghan, just quickly here. That fact that you have demand outstripping supply, how much wind is left in that tailwind?
I think ample. I will continue to see inflows on a day-to-day basis, and I think that demand is gravitating to the long end of the curve. So to the comments in the first section of your show, this bid for duration is, I think, not anywhere close to being saturated as a function of the sensitivity of all-in yields from the issuer base. So you've seen long data supply down about 20% year over year. I don't see that dynamic changing, and so I think you're going to continue to see a grabby buy side showing up for that part of the curve as and when it presents itself.
Well, Matt, let's go from the technicals to the fundamentals. There was a really interesting note out from Apollo's Torsten Slok earlier this week, basically writing that the pressure on corporate balance sheets is the direct result of the Fed keeping the cost of capital at high levels, and with rates staying high for a couple of years, the ongoing deterioration in credit fundamentals will continue to have a negative impact on employment growth and CapEx spending and ultimately GDP. How are you thinking about the Fed and the effect on credit fundamentals? Talk to us about the pernicious effects of higher rates and what that lag time looks like into the corporate credit market.
Yeah, thanks for having me on, Katie. That's absolutely true what he's saying, but it's going to happen at a much slower pace than everybody's expecting. So yeah, people like Ann and others out there have been saying recession is 2 quarters away. It's 2 quarters away. It's 2 quarters away. And it just keeps going on and going on and going on, and we're not getting there. And one of the big reasons is because everybody's been talking about it. So CFOs, CEOs are preparing for this recession, getting ready for the proverbial winter is coming, and it's just not hitting yet. So I like the fact that everybody's talking about it because nobody's getting caught off guard by it. You're seeing refinancings happening in the market. That's good for fundamentals. Companies are taking out their near-term debt, extending it. A lot of the deals that happened this week were a result of that. That means there's less debt. That's going to be a maturity wall coming up for them. So overall, the fundamentals are good, and they're going to deteriorate, but at a very slow pace. I look at the Fed, though, and right now, the rhetoric coming out of them, the way I'm interpreting it, is that holding is hiking. So they're saying that we're going to hold here, and that's the equivalent of a hike. They're done hiking, but holding is restrictive, so holding is hiking. That's eventually going to take its toll on the market, but again, it's a very, very slow pace. And the fact that everybody's ready for it, I think the fundamentals are going to hold in there just fine.
Holding is hiking. I'm going to steal that. I like that a lot. Let's talk a little bit about where the opportunities are amid that slow deterioration. Of course, I think all the way back to the start of this week, feels like a year ago, we had Moody's coming out and downgrading a bunch of small and mid-sized banks. We haven't really spent a lot of time talking about the banking issue over the past month. When you think about financial debt, is that an opportunity there, or would you expect more shoes to drop in that sector?
So I think it's an opportunity. I'm sorry, I didn't know you were asking.
Oh, sorry, Matt, go ahead.
Okay, I'll jump in. So I think it's an opportunity. I'm sure Meghan's actually getting a lot of reverse calls from people saying, can you do a reverse inquiry for XYZ, mid-sized regional banks that she was not going to be getting 3 months ago. We saw the Fifth Third Bank, it did extremely well. It was off the charts demand for that, and it tightened from there. I think that was a very good sign to get that done for the market. I look at what's happening in the issuance that came this week. Meghan mentioned ONEOK. You can buy ONEOK, and I think it's a good credit. I'm not going to say where we bought it or not, but you can buy that, or you can buy a single A regional bank at the same spread. And that's where you are right now. So with the regional banks getting downgraded or on outlook for downgrade, that was not a surprise to anybody. That was in the cards. That's reflected in the pricing. I think everybody's waiting for the new issues to come in September, and I think that's going to shore up their balance sheets, and I think it's going to be a very positive technical as price realization shows that the spreads need to be tighter than where they are today.
Well, Meghan, come in there. What kind of calls are you getting when it pertains to financial debt at this point?
Yeah, there has been outsized reverse inquiry coming in for the better part of the last month, frankly, with investors looking to deploy cash into the sector, having done credit work, having been through another round of earnings, and getting some transparency around the implications of rising rates on many of those portfolios. I think you only need to look at ratings trajectories to really understand the vast majority of IG credits remain in incredibly good shape. I mean, despite where we are in the cycle, you can look at fallen angel volumes have actually been a fraction of expectations at 13 billion compared to 66 billion of rising stars. So it's not surprising to me that we continue to see investors showing up to the plate. And I think it's hard to envision anything but buying, particularly heading into the long runway between now and September, but also because I think those borrowers that are actually in good shape in the bank space are willing to be patient here and let some spread compression materialize before they're willing to hit the primary markets.
Guys, great discussion. Really sad to say we have to leave it there. Matt Brill and Meghan Graper, thank you both so much for your time. Still ahead, it's the final spread. The week ahead, another look at the state of the U.S. consumer. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, U.S. retail sales and Chicago Fed President Neel Kashkari's remarks coming on Tuesday. And then we get the latest FOMC minutes, U.S. housing starts, Eurozone GDP, and UK CPI all on Wednesday before another round of U.S. jobless claims on Thursday. And then finally, rounding out the week, we have CPI out of the Eurozone and Japan on Friday. But before we get there, coming up at 2 p.m. New York time, just 30 minutes to go, we have Bill Gross joining me and Romaine Bostick. We're going to talk about the Fed, bonds, and whatever else really comes to mind. So don't go anywhere. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.